Hello, everybody. So today I want to talk about HIM's stock price, and so the stock is near a 52-week high. It's as high as it's been over the past year, and the question is, did I miss the boat on HIMS? Did anybody interested in this company, not investment advice, but anybody interested in companies, did they miss the boat on HIMS? Because I started buying HIMS in the $6 to $7 range, and it did not feel good to do that. Why didn't it feel good? Because when I was buying HIMS, I had some anchoring expectations because some people bought HIMS at the bottom, right? And so when I was buying HIMS, I was paying more than double what some people had bought HIMS stock on Twitter. HIMS traded at around 350, under 350 actually. And I was buying it between $6 and $7 for the bulk of my shares as I bought at this price. And, it felt horrible. I was paying 112% more than what the best buyer of that stock could have gotten. It doesn't feel good. But this is a fallacy. This is an anchoring bias, right? This is you remember what the price used to be, and therefore it makes you feel like the stock is overvalued, or this much more valued than what it used to be. But this is a behavioral finance bias. This is not the truth. Stock prices are not correlated with the true value of the company. And in fact, I am still buying HIMS and more than willing to buy HIMS right now. And today the stock is at $11.81, so almost $12. And I'm still buying. But guess what? It does not feel good at all to be buying the stock because I am paying 85% more than when I bought the bulk of the stock, 5 months ago at around $6.50, $7, right? So I'm paying 85% more and it doesn't feel good. But imagine that. Imagine if someone just finds him today and buys the stock now. They are paying 280% more than what the cheapest price could have been for that stock. So this is called anchoring, and this can lead, I think, to a lot of investing biases and a lot of poor decisions. Because the only thing that matters for me right now is that HIMS is still the second cheapest stock in all of my coverage universe. And that's what matters to me. And as long as I've ruled out for myself that, no, this stock is real, this is not a case of greater fool theory. And, typically greater fool stocks, they rise much faster than HIMS has risen. It took 12 months for HIMS to get back to the level where it is now compared to when it reached the bottom. But in the case of HIMS, I don't think this is a case of greater fool theory. This is a case of Mr. Market throwing the baby with the bathwater, out with the bathwater, because this stock was sold off unjustly in March and April of 2022 because this stock was a SPAC and the market was saying all SPACs equal bad, thus must sell all SPACs. That was the rule of the market, and this is why the stock went down so much to $3. This does not reflect, in my view, my opinion, the true value of the stock. And when you actually realize and chart HIMS with the actual numbers, you realize that while the stock was pretty much flat, doing nothing for 2 years-ish, the revenue was growing at 110% CAGR, right? And the revenue full year 2021 to full year 2022 essentially doubled from $272 to $527 million, right? Gross margin also increased, plus 94% year over year, plus 80%. So the stock is not even tracking revenue growth at this point. And in my view, this stock is not pricing the guidance. If you look at the guidance of HIMS, they are guiding by the end of 2025, i.e. full year 2025. They're guiding for $1.2 billion in sales. That is well over a doubling than the current past 12 months. So in my view, this is a long-term stock. This is a stock that I intend to own for at least 10 years. That is my expectation. Whenever I have a stock, whenever I own a stock, I want to own it for at least 10 years because I think this company has not even begun to make a dent in its total addressable market. And so in conclusion, I want to be careful, and I'm always very careful of saying it has run up too much. I see in the comment section a lot of stock that I follow. I've received a few comments saying me, "Oh, all of these stocks are overvalued. They're all so overvalued." And what do we mean by overvalued? Is it overvalued compared to the price 2 years ago? Because to me, I find that when revenue grows as fast as the stock price, the valuation barely changes. And I mostly believe in valuation based on price to sales, i.e. price to revenue, or price to gross margin. Very seldom do I use PE because the stocks that I focus on the channel are hyper-growth stocks where PE is irrelevant. I don't believe that looking at the stock price alone, i.e. a recent run or a recent drop, can tell you anything about the stock's valuation and the true value of that stock. In the case of HIMSS, the stock market is still trying to figure out how to price this stock. This stock has just not been issued as a public security long enough for the market to figure out what the true multiple of this company should be. And I'll finish with this famous example that I've said a few times in the video. So someone I know made the mistake of selling Netflix for $8 a share. $8 a share. They sold Netflix in 2009. Thought they were real smart because that stock had a major run-up, right? And I have myself made the mistake of selling Bitcoin back in 2015 at $250 a coin. I sold all of my Bitcoin at $250 a coin. And I also thought that I was real smart because everybody knew that it was totally overvalued, right? And that was obviously a formative mistake. Just like selling Netflix at $8 would have been a formative mistake. As long as the fundamentals of a company keep doing well, i.e. as long as HIMSS keeps growing revenue at 50% a year, it's important, I think, to put the stock price rise in perspective with that, right? If revenue went up 50% in 1 year, 12 months, and if stock price went up 50% in 1 year, 12 months, the stock, in my view, is the same price, roughly. It's roughly the same valuation. The valley that the stock has traveled, from the top of a mountain to the valley down to $3 to now back to almost $12 and beyond, that is a sign of the vicissitudes of Mr. Market. Mr. Market is manic depressive, as Ben Graham famously says. That's all it is a sign of. It is not the sign of a company. The company's revenue is stellar. The company's execution is stellar. The company's guidance is stellar, and I am very happy to own this stock. Again, I'm only talking for myself. This is not investment advice. This is just entertainment. This was a very short video today. I had a very busy day, but thank you for watching. Please subscribe, please like, and have a great day. Thank you.